Hey everyone, hello and welcome to Thompson Hine's ESOP Annual Checklist webinar. My name is Kelsey Mehaffie, and I'm a partner in Thompson Hine's Corporate Transactions and Securities Practice Group. My practice focuses on mergers and acquisitions, and I spend about half my time on traditional M&A and the other half on specialized ESOP deals, whether that be representing companies in the formation of ESOPs, representing ESOP trustees in the purchase or sale of ESOPs, or representing third-party buyers or sellers of ESOPs. With the new year, we thought it would be an ideal time to review the fundamentals of maintaining ESOPs and ESOP-owned corporations on an annual basis and explore key considerations that should remain top of mind for ESOP-owned corporations in 2023 and beyond. If you have any questions or comments, we encourage you to join the discussion by using the chat box on your control panel. We will try our best to address your comments and promise to follow up on any questions we don't get to during our time together. Today's program will be recorded and will be available to all participants early next week. We are also going to share a takeaway checklist after the call. Joining me today is David Whaley, a partner in Thompson Hine's Employee Benefits and Executive Compensation Practice Group. David, I'll let you introduce yourself and then get started.
Thanks so much, Kelsey. Really appreciate it. Excited for this opportunity to speak with everybody today. As Kelsey mentioned, and I'm sure many of you know, I'm a partner in the Employee Benefits Practice Group, and I spend about half my time working with large public companies on their qualified, non-qualified, deferred compensation, executive compensation plans. I spend the other half of my time really working with companies on employee equity. Now, about 90% of that time ends up being with ESOPs. Because ESOPs are so tax preferred, we see that that is a solution that a lot of clients choose, and we work with a lot of those clients. Today's presentation, we're really sort of going into two spaces. We're going to look at some of the ESOP/benefit-specific annual compliance factors that we have, both for an ongoing plan and for a new plan, and sort of think through some of those aspects that you, as a plan sponsor, you as a plan administrator, with respect to your company, have to go through. Then we're going to turn and look a little bit more at the spaces with respect to corporate ownership, corporate governance. Now, some of those are, again, a little bit ESOP specific, but some of those are ESOP specific not because you have a retirement plan, but they're ESOP specific because of some of the factors we see with ESOPs, the debt, the leverage that gets put on a company, and so the concerns or considerations that you have in that space. So really sort of thinking of it in twofold. Want to make sure and mention anything that comes up here that you have questions about, please reach out either in the chat box or afterwards, give us a holler. We're happy to help, happy to lean in and assist. Also, a lot of the work that we have with respect to this, some of your other service providers really are the leading experts with respect to some of your record keepers, maybe your bankers, maybe some investment bankers that had worked with respect to deals inside of new formations. So feel free to also reach out to among us and those other parties if there are questions that really arise in that space. So getting started. That is a picture of when I was much younger. So we look a little bit better there than we do today, but you can still see us here working. We have these annual checklists, these notices for participants. These are ERISA required notices. They're code required notices. These are required notices that exist with respect to retirement plans generally. So pension plans, 401k, profit sharing plans, and ESOPs. There's a requirement that you have the summary plan description given to new participants within 90 days of entry into the ESOP. Now, that's a general rule for a new employee that gets in. There's an exception with respect to some new plans that you have a little bit longer time frame. But that summary plan description, the reason why we think of this with respect to an ESOP is because so many ESOPs are forward eligibility. A person becomes a participant on January 1st. A person becomes a participant on July 1st. And so within 90 days of that timeline, you're going to want to give them the summary plan description. Now, that summary plan description is a generalized version of what's in the plan document. It's an attempt to be read by individuals, employees, and understood as opposed to necessarily looking at the 80-page document that has all the legalese that's required. So we try to really boil down in almost a frequently asked question scenario how the plan works, how people should expect the plan to work. We also have the summary of material modifications. Now, summaries of material modifications are things that were amendments to plans, but aren't contained in the summary plan description. Now, we have some clients, some may be on the webinar, that actually don't prefer to have summary of material modifications. They prefer to instead just update their summary plan description every time that there is a material modification of the plan generally. That summary of material modification, though, is if you do update your SPD in that timeline, Anytime you'd have that update, you'd have to send out the full SPD to everybody. Now, so realize that there's some catch with respect to that ability to accomplish it. Now, generally that needs to be delivered to make the safe harbor standard, really needs to be delivered in paper to the employees, but a lot of our clients have moved away from the safe harbor, especially after the adoption of the Affordable Care Act and then also COVID, some real movement inside of ERISA to allow for electronic delivery of these documents. And so what we're seeing is a lot of employers, if employees have access to computers, they just send an email and say it's on the intranet. Another factor, the way that we're seeing this a lot of times is actually what we call postcard notice. Send a postcard to the employees at their home and indicate to them that if they go to XY website, maybe an intranet website, or maybe it's an extranet website at their record keeper, to be able to get and download a copy of those documents. We also really want to make it clear that people should be able to call or come into HR and get a paper copy of those documents. So realize that we have some abilities, some questions pertaining to those, but you're something you want to think about on an annual basis for new entrants or for modifications. On top of which, we have the summary annual report. This is a requirement that actually, it's really supposed to summarize what's in the 5500. That 5500 being the annual report that's filed with the Internal Revenue Service and the Department of Labor. It's a report telling the participants, hey, you've had a filing with respect to your plan made with the government agencies. It's out there. Here's the information that was contained with respect to it. These reports are a little bit more general for an ESOP than they are for a profit sharing plan or for a 401k, but they really are that indication that people can get to the 5500. The reason I want to mention that, and we'll talk a little bit more about the 5500 after this on the next slide, but it's important to realize you're sending this notice telling participants there was a 5500 filed. Those 5500s are public record. Anybody can pull them. And so if you have participants that are looking and are asking questions, realize about the plan, and after you've sent the statement, realize they very well may be looking at the 5500. They might have gone online to, we call it EFAST, it's the Department of Labor's website, to see that 5500. So maybe if you're getting questions about what went out in the summary annual report, you might want to have a copy of that 5500 handy to be able to answer the questions so you don't get misdirections from your employees about what's happening with respect to the plan. That's even more true for plans that have over 100 participants, because plans that have over 100 participants are going to have an audit requirement. And that audit requirement is going to have a lot more language in it than just the numbers that are required to be filed in the plan or in that 5500. And so that audit requirement, it really is a space that people that get their hands on it may ask questions. You want to be prepared to be able to answer those questions. Last bullet point here, participant statements. These are literally the statements you're sending your participants, explaining how much money is in their account. This in an ESOP company is usually a big day. It's usually a big event, because what you're telling them is how many shares they have, what the value of those shares are, and how much really you're thinking about how much growth is going to be there whenever I retire. Now, interestingly, that day is really sort of a day that we end up having a lot of celebration or planning around for participants. But also this year, for the first time, we're going to have a little bit different challenge with respect to those statements. The Secure Act, we call it Secure 1.0 because at the end of this year, Secure 2.0 passed, required statements of lifetime disclosure or lifetime income disclosure for participants. Now, this was written in all plans. It's all defined contribution plans, so it captures ESOPs, but it's really desired to try to drive home to people that have 401k plans with some match or with some profit sharing to understand that the $10,000 they have in their account is not going to be enough for retirement. And so you take the $10,000 that's in your account, you figure out how much it's supposed to grow at an interest rate towards retirement, you assume that you have some additional contributions to that, and we get to what's in an annuity amount, an amount that each month a person would have in their account at retirement to be able to pay for their lifestyle to be able to retire. A little bit easier philosophy, although it took about 10 years to get through for just the general account-based plan. An ESOP's different though, and we know an ESOP's different. An ESOP's different because especially at the beginning of an ESOP, if you have a 100% leveraged transaction, that stock's not worth a ton. It gains value as the debt's paid off and that debt goes down, the stock price goes up. It gains a lot of value because a lot of shares get allocated at the beginning. And on top of which, the means of being able to take the money out in a lump sum is not necessarily there at retirement. So we're having a lot of challenges talking with our plan sponsors about what the messaging around the delivery of this value will be to participants. And this being the first year that it's required to go out, We really think it's important that whenever that statement, that additional language is put on a statement to the participants, that there be a conversation with the employees directly about it, and maybe some modification from what the Department of Labor had as the model language to explain an ESOP's different. We want to make sure that people are planning correctly. We also don't want to create unjust expectations of what value of stock should be at retirement with respect to these factors. So really, this year especially, spend a little bit more time planning to spend a little bit more time on those participant statements to make sure that you're giving the information that's beneficial to your employees, but also not going to create risk for you as the company and sponsor. Other notices that we have to deal with annually, diversification notices. So individuals who have had 5 or 10 years of service in the plan and have reached age 55 are going to have the opportunity to make a diversification election. A lot of plans have earlier diversification or later diversification rights as well. These are opportunities for active employees to move out of company stock and into either a cash distribution directly to them or another investment option that's offered within the plan or within the 401k. It's a way for people to take some chips off the table while they're still working. So we've got to send these notices out to participants to say to the participants, hey, you have a chance to be able to diversify out and how much you're able to diversify out of that stock. Now, what's interesting is the statute requires that the diversification notice go out 90 days after the plan year. But we all will not often know the value of our stock within 90 days after the plan year. Good news is that the IRS has really given us some leniency inside of this to basically say we can send this notice when we know the stock price is received. Whenever we send that notice out, though, we're going to end up treating it just like a distribution form. People are going to have the ability to be able to hold it for 30 days. It's good for up to 180 days. Now, typically, we cut off the timeline with respect to diversification elections before that, but they're going to end up needing to see forms that don't look any different than what the distribution notices are, with an exception of explaining what this diversification right looks like. And so it really becomes very particular to a plan, especially if you have early or late diversification rights that are offered within that plan, and very particular to a participant, because how much their diversification elections are in a given year are modified based upon what their historical diversifications have been. And interestingly, if you don't have expanded diversification after 6 years, the opportunity goes away. And so we really need to make sure that the communication to this crowd of people is very, very tailored. Interestingly, we have a good number of clients that have very active diversification. We have other clients that have had no diversification. So it's really one of those things to think about, but it may be very material to think about in a year like this, where there's a chance that for a mature ESOP, values had flatlined or potentially even gone down with respect to some of the concerns pertaining to inflation in the economy. So really a good year to think about the way that diversification is communicated, and a good way to make sure you're planning and thinking about your diversification and repurchase obligations as those notices go out. Distribution notices. Individuals are going to receive distribution notices with respect to their annual distributions. Realize that this is an impact with respect to whether or not you do lump sum or you do installment distributions, largely because what you're trying to do is figure out where that money is supposed to go. Those participants can roll the money over to an IRA. Those participants could roll that money over to another qualified plan if they've terminated and started working elsewhere. Those participants can take the money and actually just use it for their own purposes as retirement distribution. This is what the biggest part of the distribution notice is filling out. It's saying to the participant, you have the right to take your money, or in certain instances when they're at retirement age, you have the requirement to take your money, and the right or the requirement to take the money, where do you want us to send it and how do you want us to send it? So those notices have to go out anytime in the year following after we get the shock value, but they need to be outstanding for at least 30 days, but no more than 180 days. After 180 days, those notices are stale. Finally, we need to pay attention to required minimum distributions. Required minimum distributions are due to individuals that are of a certain age. And I say a certain age because this age keeps on moving. It was originally 70 and a half, and then Secure 1.0 made it 72 for a set of individuals after birth dates. And now we're Secure 2.0 moving up to a 75 in a set of time. So realize we're pushing out that required minimum distribution date further and further. Now, realize that this really is a crowd of people that if you provide or require distributions to be done at retirement, usually does not actually exist, because if a person is an employee of 100% owned ESOP, they don't have to take a required minimum distribution so long as they remain an employee of 100% owned ESOP. It becomes a challenge if we let people hang in the plan. And we let them hang in the plan after termination, we let them hang in the plan after retirement. And they get up to that 70 and a half, 72, or 75 date, depending on what year we're in. So we need to pay attention to this crowd, but it really is a larger problem for 401k plans than it is for ESOPs. As we noted before, you have the Form 5500 annual report. This is a form that it's required to be filed working with your record keeper to be able to deliver it. It's due within 7 months after the close of the plan year, so July 31st for a calendar year plan year. It can be extended for an additional 2.5 months. Now, interestingly, it's extended automatically if the plan sponsor actually files an extension of their tax return. It is not extended automatically if they do not. And so we end up thinking that it's really, if you're going to extend, it's really important to file that Form 5558 extension, and your record keepers will often prepare that to be filed immediately for your use. But it's something to pay attention to as we get to the end of July. Realize, again, if you're over 100 participants, there's an audit that's required. And that audit really can't get into hard work on what's happening with the plan until you get your value. And you usually can't get your value until you get your consolidated or reviewed or audited financials for the company done. So there's a whole stacking of things that starts now to get to that Form 5500. Financials have to get done, valuation has to get done, financials get finalized, financials begin to get to the Form 5500. Form 5500 plan has to get audited to be able to deliver with the Form 5500. So we are often looking at into June, July, August with respect to these, even if you start pretty early in February or March. So there's a timeline you want to pay attention to. Finally, the Form 8955 SSA. These are the term vested participants that are required to be delivered with the Form 5500 so as to communicate to Social Security Administration that there are amounts that are available to participants in this plan. I think it's really important to make sure that we get, if of anything, to get the information inside of these correct as compared to other requirements. And the reason why I say that is because what ends up, what SSA, what Social Security Administration does is when a person comes in to file for their Social Security, they search their records and try to figure out if there's any, we're going to call it lost or abandoned retirement money in vested accounts from terminated participants. And they'll send a notice to the participant going, hey, we think you have some money there. How they figure that out is that the SSA was filed and a corresponding 1099 for a distribution was not filed with respect to that individual. And so when you have the SSA filed and a corresponding 1099 not filed, then SSA sends a letter out saying, we think you may have money there. Well, how does that become a challenge for a plan sponsor? It becomes a challenge for a plan sponsor if the SSA or the 1099 aren't filed exactly the same. If they don't necessarily match enough, that SSA thinks that there wasn't a 1099 filed for the SSA that was filed. In that instance, you'll get a participant that will actually receive the notice from SSA, and they're going to come back to you saying, where's my money? And what ends up happening is those clients end up turning to us often to ask to write a letter explaining you received a distribution in X date. We've had a couple of these done such that whenever there were large corporate transactions, a bulk of the SSAs or the 1099s were filed differently / incorrectly. And it ends up that we spend years writing the same letter to participants over and over. So you really want to work with your record keeper and make sure there is coordination, not only on the 8955 SSA, but also the 1099s that correspond to those to close out how those two work together.
And David, we have a question in the chat about financials. If we close our transaction 12/30/2022, will we need to have an audit for plan year end 12/31/22, or would the first audit be for plan year 12/31/23?
Yeah, and I'd have to look at it specifically, but the answer is generally you're going to have an audit requirement with respect to that unless, and this is the one exception, you have a short plan, you adopted a plan after the plan year, which you're allowed to do now under 404A6. And in that instance, you actually don't have a Form 5500 requirement to with respect to the plan year that the plan was adopted. Let's give that example. It's an unusual one. In the time in which you had we think of IRAs, I can set up an IRA now. I can fund an IRA contribution for 2022, so long as I do that before I file my 2023 tax return. Makes sense, and it's pretty simple. We're now allowed to adopt plans in 2023 have them retroactively effective for 2022, even though there was nothing there in 2022. There wasn't even a plan document in 2022. And as we have the retroactively effective for 2022, we do not have an audit requirement because the theory being there wasn't actually a plan due then. Your first 5,500 and your first plan audit would be due for 2023. That's not necessarily, I don't believe that's the same as you would have with respect to Form 5500s or audit requirements that were actually adopted in the prior year and due with respect to that prior year. Okay, so then we have 1099 filings. The ESOP benefits annual checklist filings with the DOL and IRS. Say if we think about this, these are the forms we have to send to the IRS to explain how much money came out of the plan. Why do we have the need to have how much money came out of the plan? It's because they want to be able to capture what taxes should be otherwise due from out of the plan. So you have a 1099-R. This is just a standard garden variety distribution from the plan. Realize though, and this is the interesting tag, distributions made in 2023 are not issued on 1099s until January of 2024. So those 1099-Rs go out in 2024 with respect to 2023 distributions. So if you're thinking about those now, the 1099-Rs that are being made in 2023 are with respect to distributions in 2022. In coordination with the 1099-Rs, there's a 1096, which really is an agglomeration of the 1099-Rs that are sent out to the IRS, on top of which there's a Form 945. Now, what's interesting about a 945 is it's actually the reporting of any withholding that's done from a distribution that was made. So if there's a balance due with respect to that, it's due by January 31st. If there's not, it's due by February 12th. ESOPs are a very interesting vehicle, though, and it's one to think about whether or not you actually do have a withholding requirement. And when we think about distributions from an ESOP, there are really two ways they can get paid. We can get cash into the plan to pay a participant their value balance out from the plan. And in that instance, we're literally writing a check from the plan, the trust, to the participant. And as we write that plan from the trust to the participant, we end up actually making a distribution to cash. And if that distribution to cash is not to an IRA or to a qualified plan, it's subject to a 20% withholding requirement. Well, that withholding requirement is going to be subject to a Form 945. We're also allowed to distribute the stock out to the participant and have the company immediately buy the stock back. If 100% of the distribution to the participant is stock, though, and not cash, there was not any cash distributed from the plan from which to effectuate the withholding. So in that scenario, we actually have the redemption of that stock by the company. There's nothing that would end up requiring for a withholding. Therefore, there would not be a 945 that's actually filed if all of our distributions are done that way. Now, it's unusual for a client to have all of their distributions done in that means. It's possible. But if you have all of your distributions that are done in that mean, then you wouldn't have the 945. What really happens with ESOPs is their 945 filing and their withholding requirements are usually significantly smaller. Very small accounts will be paid directly through the plan, and larger accounts will be paid with respect to a distribution of stock and a redemption of that stock. And so it's really one of those spaces that your 945 filing requirements going to look a lot different than your 401k or your profit sharing filing requirements for the same, because there's not cash necessarily coming out of that ESOP to participants' hands.
And we have one more question. Are former employees who still have a balance in the plan but have filed for SSA disability insurance required to draw from the plan funds before they can receive SSA funds?
So interesting, it really becomes a question pertaining to whether or not that cash would actually cause them to not qualify for SSA disability. And that really ends up being a question pertaining to their filings with respect to SSA, as opposed to our challenges with respect to whether or not we have to owe them money. What I will say, and I think this is important, with respect to a participant that terminates employment, there is an ability to delay the payment of their monies for up to 5/6 years, the fifth plan year beginning after termination, before we would even offer them the opportunity to start a distribution. There are exceptions for death, disability, and retirement. So now we get some leeway with respect to what the disability definition looks like. But in that disability space, if a participant is disabled, and if they're SSI disabled, they're almost always going to be disabled, then they would have the ability to take the distribution from the plan pursuant to our election. Interestingly, we do not have a requirement to actually give them a lump sum. We actually can start their distribution and we can pay it over a 5-year window, but we do have to offer them that chance starting in the year following their termination as a result of disability. Now, whether they have to take that full amount before they actually qualify as SSI disabled or qualify for dollars, I can't say. That really ends up being a question pertaining to their specific disabilities. So, and then finally, from my space, here, the finance annual checklist. And this is one of those spaces that really ends up being not only ESOP, but also company driven. But a lot of it's driven because you are an ESOP. What do we end up valuing these companies based on? We end up valuing companies based on projections, management prepared projections. And so from each year, your trustee and your valuation advisor are going to ask you to put together a 3 or a 5-year projection of what you think the company is going to do. It's a great budgeting process to be able to really drive goals home for the operations of your company, and driving those goals home with the operation of your company to be able to show to the employees, let's do X, let's do Y, we can drive value. But management has to prepare those projections, and we really think it's necessary to involve all employees inside of sort of a bottom-up process for the creation of those projections. Whenever those projections are provided to the trustee, along with a conversation with the trustee of how the projections were prepared, what management sees in them, the trustee and the valuation firm will come back with what a value is for the company as of the end of the plan year. It's necessary to review that annual valuation on behalf of the company for a few reasons. First, you really want to review that valuation to make sure it's right. Now, that doesn't mean you do math. It means that there's a requirement that the board, the company, standing over the trustee and over the valuation advisor as a fiduciary, make sure that there's not materially incorrect information inside of that valuation. Well, how would you, company, know that there's not materially incorrect information? One of which is sometimes that we end up literally having incorrect data from what we was handed over. We handed over projections that said X, and we look at the projections and they literally say Y. And so we go, you guys did not have our projections correct as to what we actually said, what we showed whenever we went through this process. Sometimes it's a conversation pertaining to risk. The report will detail a risk that the company disagrees as being strong, or downplays a risk that the company sees as being great. And so you want to be able to communicate those factors with respect to the trustee and the valuation advisor to make sure those factors are overseen correctly and incorporated correctly. The final reason is why, because it really shows an implied value of the company. And I think that this is really one of the spots that we actually want to walk through, is that we've seen the past 2-3 years more merger and acquisition activity inside of our ESOP space than we've ever seen in my career, at least. And so what you end up really having is you have a lot of private equity groups, you have a lot of public companies that have a good amount of cash on their balance sheet. And that cash on their balance sheet, they have to put to use. And they really have to put it to use in an inflationary time, because the cash is becoming worth less. Not worthless, just worth less as interest rates have gone up. And so they're being told by their boards of directors, they're being told by their investors at the private equity or family offices, put that cash to use, go buy something. Well, those somethings sometimes end up being ESOP-owned companies. So we've seen a lot of unsolicited offers come to ESOP-owned companies. The only ability to be able to know what an unsolicited offer is worthwhile is by understanding what the value of your company is. And then you have to think about, is it not just more than $1, but how does that waterfall work? So we think that as a part of this process, it's necessary to look at the value that's given from a transaction, but also look at, from an annual valuation, and then compare that to a level of what a value would be in a transaction that would make people actually pause and think that's worthwhile. Now, we're also seeing, because of these unsolicited offers, a good number of companies adopting unsolicited offer policies, meaning that they actually have a policy and procedure as which any unsolicited offer goes through before it would even get to the board, before it could even get to a trustee. So if you're in a space that you have a good amount of activity or with respect to your company, it might be a good idea to actually start thinking about putting together an unsolicited offer policy for your company. What's next? You want to take the balance sheet, you want to take the projections and review the covenants from your bank documents. Make sure that the covenants are met historically and going to be met in the forward with respect to the company based upon the projections and the cash that you have. If there's going to be any challenges, you want to communicate with your bank immediately and start that process now. It's much, much easier to deal with on a forward basis than a backward basis if there's going to be covenant challenges on the bank documents. Further, with a lot of times we have a lot of companies that have actually paid down a good amount of their bank debt from a transaction, and it's the right time to go back to the bank to borrow some more money to pay more of the seller note in a transaction down. So that's a good time that they've seen how the cash is looking, seen what the future looks like, to be able to go back, borrow more, pay down more seller debt. And then finally, with respect to first-year ESOP specifically, it's really important that you dig through those either at the end of the year or inside of the timelines with respect to the transactions. You'd look at the post-closing deliverable and covenants in the SPA, the net working capital adjustments, any audited annual financials that have to be delivered to the trustee, and the compensation limits that may be in with the projections. Look at those to make sure that there is otherwise compliance with what we promised inside of the purchase agreement, and we don't need to accomplish anything as a part of that purchase agreement as we move forward into the second year of being an ESOP. And finally, unfortunately, we've seen this mistake happen, but for ESOPs that were C Corps for a 1042 and are going to make an election to be an S Corp as of the next year, make sure that S Corp election gets filed by March 15th, retroactive January 1st for our calendar year planning years. You want to make sure that that's accomplished. And one of the catches on that is there are different positions with respect to different accounting firms, but it may very well need to be signed by your trustee as the sole shareholder. And so if it needs to be signed by your trustee as your sole shareholder, it's sometimes hard to find them on March 14th. We probably want to start that process a little bit earlier, start it about now.
David, we have one more benefits question before we move to the corporate stuff. In conducting your 401k audit, should we include the ESOP audit? And if yes, am I correct in understanding that the two will not match up exactly?
Yeah, so they don't match up exactly, but we often see our clients choose an auditor for their 401k and an auditor for their ESOP that are the same. And the reason why is because we're communicating to one person, one group with respect to that information. Secondarily, the biggest factor of a 401k audit ends up being compensation data audits. They're auditing feeds of elective deferrals from participants' payrolls into the 401k. They've set up processes to evaluate those compensation evaluations. That process that they have for the compensation evaluation does carry over to the ESOP. And so since it can carry over to the ESOP, now I get it's not elective deferrals, but it's still the same definition of comp often, or it's the same factors with respect to the definition of comp. You're going to get some economies of scale inside of doing that audit at the same time. Also, our clients tend not to like to have auditors around. And so if we can have only one audit firm around for one time to do both of the audits, sometimes it's a little bit easier on everybody. And so we tend to see those done at the same time by the same accounting firms.
Okay, thanks, David. So now we're going to move on to, David covered, everything benefits and financial related. We're going to move on to everything else, some corporate and commercial stuff, and also some labor and employment and real estate topics. So David speaking about the financial covenants and the purchase agreement is a perfect segue to what we're going to talk about next, which is more of the corporate related covenants and the purchase agreement. So we're going to start off talking about corporate requirements for first year ESOPs. So like I mentioned, this is all going to come down to reviewing your purchase agreement closely, remembering what you negotiated with your trustee, and then delivering on those covenants that you signed off on in the purchase agreement. And thinking about this sort of high level, for a first year ESOP, you're probably going from the sellers being, members of the board of directors, also probably the CEO or officers of the company, they're filling all of those roles. And in the transition to an ESOP, you're now owned by an independent third party, the trustee, the ESOP. So the trustee really wants to see ESOP-owned corporations observing good governance practices, and that's where these covenants stem from, and the why behind all of these things that we're doing and putting in the purchase agreement and negotiating with the trustee. Another good thing to keep top of mind, thinking about how things change pre-closing to post-closing for ESOP-owned corporations, are the differences between LLCs and corporations under state law. So many of you pre-closing might have been coming from an LLC. Your company may have been set up as a limited liability company rather than a corporation. And for our company side clients on the line, we may have either done a reorganization or put in place a holding company structure, or maybe converted you from an LLC to a corporation. The reason for that is that ESOPs can only own corporate stock. They can't own interests in limited liability companies, or at least nobody's willing to risk that right now. And so part of these changes are also driven by the fact that you're just moving from an LLC which has much more limited formalities in its governance to a corporate form. So those are kind of the balancing factors. And the background here is that you have a third party that owns the corporation now, and at the same time, you're moving from maybe a corporation, from an LLC to a corporation. So for first year ESOPs, like I mentioned, you're going to want to look at the covenants in your SPA and get really familiar with those, the timing aspects and what exactly needs to be done and the definitions and everything around that. The biggest, one of the biggest things corporate governance wise that you're going to have to change is that you'll have to create a nomination and compensation committee, and maybe for some of you an audit committee. If we did your ESOP deal, we probably already amended your bylaws to cover these things at closing or as a part of your reorganization. If you haven't updated your bylaws, that's the place to authorize those committees, is in the bylaws, and you'll need to amend them to provide for a nomination, compensation, audit committee, whatever is in your SPA covenants. Then you're going to have to actually appoint those initial members of the committee. In the SPA, you'll have to look for the exact timing, but it's normally 12 months following the closing. And those members are going to be board members that are then appointed to the committee. And it's normally a mix of the sellers and then independent directors that are being added to the board post-closing. We also normally see that the independent director has to either be a member of the committee or chair the committee. It just depends on what you negotiated with the trustee and what ended up in your term sheet and your purchase agreement. So those are things to look back at. Also, it will be a covenant in your SPA to hold annual shareholder board and committee meetings. That's a covenant in the SPA, but it's also just a requirement under state law for corporations. Like I was mentioning, the difference between LLCs and corporations. And also you will probably have a covenant in your SPA that a certain number of members of the board of directors need to be independent. That definition of independent is something that is negotiated with the trustee as well, but we normally find that there's a very similar definition that you land on. And independent means no sellers, no employees of the company, no service providers of the company that have received a certain amount of money within a certain period of time prior to their appointment, and also no family members of those people. So that's typically where we land on what does independent mean. You're also going to negotiate with the trustee the number of independent board members that you have to have, and it's normally just sort of a ratio between people who are independent and people who are not independent. And like I said, you end up with sort of a mix between the sellers or existing leadership in the company and then a few independent folks. The process of determining your actual independent board member is really a dialogue with the trustee, but mostly driven by the company. So typically we find that the sellers come up with someone that they want to propose to the trustee, and the trustee really just wants to be in the loop and get a chance to see that person's resume, maybe have a phone call with them, get to know them, make sure there's no red flags. And the trustee we find is generally agreeable to whoever the sellers want on the board as their independent trustee. Next slide. So for our ESOPs beyond the first year, like I mentioned, we're going to, on an annual basis, reappoint the nomination, compensation, and audit committee members. And that's, again, just a requirement of corporate law, but also required under your SPA covenants. And then also going to hold annual shareholder board and committee meetings. So the shareholder elects the board of directors, and the board of directors then in turn appoint the committee members and the officers on an annual basis. The board is also going to monitor the trustee. So the trustee is the trustee of the ESOP trust and is sort of an independent third party in that sense, but the trustee is also engaged by the company. And so the board does monitor the engagement of the trustee. And the board can also remove the trustee if they are monitoring the trustee and see fit to do so. Some other records requirement is that on an annual basis, you should be updating your stock certificates and stock ledger. And this goes back to allocation, which David mentioned. So if you think back to your ESOP formation transaction, the corporation made a loan to the ESOP, and the shares that the ESOP purchased at the closing are pledged under that loan and then released as the ESOP pays back the loan with contributions from the corporation. As those shares are released from the pledge, they're allocated to participant accounts. And then what we should end up with is one certificate each year that reflects the allocated shares and one that reflects the pledged shares. And we want to update this each year just to keep good records of where the allocation stands. Next slide. So here's sort of an image of the circular sort of corporate governance structure that I was talking about earlier. So if you look starting in the lower left corner with the ESOP trustee, we see that the board of directors hires or engages and can remove and monitors the ESOP trustee like a third-party vendor almost, just it's a third-party relationship. But also the board of directors is going to appoint members of the nomination committee, and then the nomination committee is going to deliver a slate for election to the board of directors. And keep in mind that nominating committee consists of probably the sellers or other people in management plus those independent directors. The ESOP trustee, as the shareholder of the corporation, is required under corporate law, is going to approve and vote for and elect the board of directors. Those board of directors, as required under state corporate law, are going to appoint the officers of the corporation, and those officers are going to select the managers, and the managers hire the employees, the participants in the plan. So this is all sort of a circular corporate governance structure that we put in place to meet the requirements of control that the trustee needs to have as the shareholder of the corporation. But really, it all goes back to the trustee is still a third party that can be removed by the board of directors. Okay, so some other corporate steps, sort of moving outside of the ESOP space to more of a general corporate space. Some of you in your corporate structure might have other entities, maybe just not the corporation that's owned by the ESOP. Maybe you have subsidiaries that are LLCs. And like I mentioned earlier, LLCs have a much more flexible governance structure. So corporations are governed mostly by state law and have to have annual meetings, and that's a requirement under state law. But LLCs are really governed more by their operating agreements. It's a more flexible structure, and you can sort of create your own operating agreement and decide your own governance structure there. But if there are any changes to your officers or managers of the LLC, you should prepare resolutions at that time and keep everything up to date. And then also for LLCs, you should still be approving by a formal resolution any major actions you're taking. So for example, if you have any extraordinary events like a bank loan or a purchase of real estate by the LLC, you should still document that with a formal resolution, as well as formal resolutions for any changes to officers or managers of the LLC at that time. But the nice thing about an LLC is that if there are no changes, if there are no extraordinary events of that LLC that's a subsidiary, then generally you don't need to have annual resolutions or meetings. Another point, thinking about Secretary of State filings, you need to file annual reports with Secretary of State in all jurisdictions. So the state where you are incorporated or organized, and then also any states where you're qualified. You also want to be regularly monitoring the Secretary of State registrations for expirations. And a good example of this is trade names in Ohio only last for 5 years. So if you are incorporated or organized under one name and you want to operate under a short form name or some other name, you can register that trade name with the Secretary of State, but it only lasts for 5 years. And so you do have to go back in and renew that. So that's something to calendar and keep an eye on. And then another thing to keep in mind, both with qualifications and other registrations with the Secretary of State, if you no longer need a qualification or a registration, you should keep track of those and remove them so that you have one less annual filing requirement or registration to keep track of. So for example, if you are registered to do business in another state because you had employees there or some type of operations there, and then in the next year you no longer have operations there or you don't intend to operate there anymore, you can withdraw that qualification and have one less thing to keep track of. Another thing to monitor on Secretary of State registrations is your registered agent for service of process. You definitely want to make sure that that is kept up to date. So your registered agent is the contact person or entity and the address where service of process can be delivered. So if you are sued, that individual or entity would be served with the papers to notify you that there's a lawsuit against you. So that is obviously very important to keep up to date and make sure that that individual or entity is still there at that address. You have the right person, especially if it's an individual and not a third-party service provider. You want to make sure that it's a person that's going to notify you if they receive service of process. That's key. One thing that you can also do is hire a third-party service company to serve in that role for a fee. So they will keep track of everything, notify you. They'll generally notify you also when your annual report obligations are due, but that's just a third party you can hire to sort of keep track of that for you for a fee. And then another thing that you'll want to keep track of is your business licenses outside of the Secretary of State's office. For any renewals or if you have any changes that come up, you'll want to keep those up to date. Next slide. So the next slide gets into sort of maintaining your contracts outside of your corporate records. So on an annual basis, you're going to want to review your vendor and customer contracts for expirations and renew as is required or desired. You also want to be looking out for auto renewal provisions. Some of those could require notice in advance. And so not only do you want to keep track of the expiration date, but also the date by which you need to provide notice of intent to renew. You also want to be sort of reviewing those relationships as renewals come up and make sure there aren't any terms that you need to update, like pricing or even in the boilerplate. Or if you have a new form of agreement that you'd like to use, renewals are a great time to do that. You also might want to consider creating a checklist of standard terms if you enter into a lot of contracts. So think about things like insurance requirements that have to be filled into contracts regularly and really get your arms around what you can promise as far as your insurance coverage. Think about things that expose the company to risk, like limitations of liability or warranties and indemnification. And then you'll also want to create a central repository with signed copies of all contracts so that you can be monitoring these things like renewal dates and expirations and what terms you've bound yourself by. And also, David mentioned, in a sale of a company, if you have to provide diligence, then you have everything in one central location. And then finally, on contracts, consider training for your sales representatives. So think about your people who are on the front lines every day, interacting with your customers and vendors, and what they're signing without reading and things like that, potentially exposing the company to undue risk of terms by just clicking yes, in websites to accept counterparty terms, and also train them on using standard company paper rather than customer or vendor paper. And if you don't have an in-house attorney, you may also want to think about designating, a key person, the CFO or something, to raise these questions to when things come up. Next slide. So here are a few things in the labor and employment space to also keep tabs on. This is definitely a space that is changing all the time and varies by state law. But just to give you a few high-level items, so annually you're going to want to make sure that your employee handbook and employment policies are up to date, and that's something that will vary based on state law, and you probably need to think about where all of your employees are located in which different states and making sure your handbook covers all those state laws. You also want to confirm that your policies and practices are consistent with wage and hour requirements, which also depends on the state. And you also want to confirm that you're paying the required minimum hourly rate or salary in each state. You also need to confirm that your independent contractors meet the applicable tests to be properly classified as 1099s and not employees. And so, as I've mentioned on several of these points, it all depends on differing state law, and state law is sort of changing rapidly in this area all the time. So our labor and employment practice group has put together a really helpful publication that comes out on a monthly basis and tracks all of the changes in state laws. So I mentioned that we'll have a little takeaway checklist that we send out after this, and there will be a link to sign up for that publication. Next slide. Okay, and on real estate, thinking about your leased property, it's sort of the same analysis in a way as going over your contracts. You definitely want to keep an eye on deadlines for your right to renew your leases, or if you're looking to get out, you want to have a good handle on your termination rights or any rights of first offer. And if your lease is coming up for expiration, you want to engage with the landlord or a broker to explore the renewal rights. If you don't want to stay in your lease and your lease is coming up for expiration, you're going to want to review all of your obligations as the tenant upon vacating. So there could be a requirement that an inspection needs to take place. There could be a requirement that you have to remove certain improvements, which can be costly. So you definitely want to get your arms around that. You also want to review your insurance coverage, and I mentioned that on the contract slide as well, but you want to be in compliance with what you said under your lease that you had coverage for. On owned real property, you're going to want to regularly review the property condition and your capital expenditures needs and keep your property up to date. And you can also consider tax appeals if the valuation of the valuation of your real estate, if that's appropriate. And next slide. So that concludes today's discussion. We're happy to take any questions. If you'd like to enter those in the chat box now. As mentioned, this webinar was recorded and will be available to view in our library of recordings on Thompson Hine's YouTube channel. Make sure you visit the page and hit the subscribe button to stay up to date on all our content. The recording will also be sent out early next week to all attendees, and we will be sharing a takeaway checklist with all this content after the call. Any questions? Give everyone a minute. And can we get a PowerPoint, a copy of the PowerPoint as well? Yes, I think we can circulate that, and we can send it out with the recording and the checklist.
So, Kelsey, one of the questions that I've gotten whenever I've had this conversation with clients before is what's the most common mistake that gets made on an annual basis with respect to plans? And I always tell people, I think that what you have to think about is in the corporate aspect, you were talking about the stock certificate, right? You have a plan that has a leveraged ESOP loan. And that there's part of that loan that's going to be allocated to participants' accounts. Let's say we have 100,000 shares, we make a contribution on the loan, 10,000 shares fall out to the participants' accounts. That really means we should have two stock certificates. It means we should have a stock certificate for 10,000 shares and a stock certificate for 90,000 shares, to show that the 90,000 shares are unallocated, and the 10,000 are allocated and not subject to the pledge. Now, that problem is not a big deal. We have a lot of clients that miss that. We correct that when we get to a space of a transaction. What that leads to is actually the problem that I see that is a challenge. That whenever the person that has part of the 10,000 shares terminates employment, the way in which they get their money for, let's say, their 100 shares matters. And because they can get their money for their 100 shares one of two ways. They can get their shares for the 100 shares as money through the plan. Company makes a contribution to the plan, pays that individual out. Well, those 10,000 shares stay in the plan. And there's not a need to modify the stock certificate, and those shares have stayed in the plan, and the participant would have a direct distribution. Or we can have those shares distributed out to the participant and then redeemed by the company. Whenever we do that second, when we have those shares distributed out by the participant and then redeemed by the company, we really do need a corresponding modification of the stock certificates because we literally have decreased the number of shares that are outstanding at that point. Secondarily, and this is really important, we need to make sure money tracks. The money for that redemption should not come from the trust. It needs to come from the company in redeeming those shares. And the reason why is because if that money comes from the trust and it's literally buying shares of the company back from the participant in that distribution, we could have a prohibited transaction because the ESOP is buying its own shares at a value set as the end of the year, not as a current valuation. And so we want to make sure we follow that process. So I always think that mistake starts with thinking about the share certificates. And if we're literally distributing the shares out, let's think about the way that paper would flow so that in my example, we only have 99,900 shares left in the plan and not 100,000 shares left in the plan because we redeemed away 100 of those shares. So if you think about that from the stock certificate perspective, I think it gets easier and it also becomes rote with respect to your annual processes.
Right. And David, we got one more question in the chat. Is there anything ESOP companies should be thinking about now with respect to the ESOP specific Secure 2.0 provisions that take effect later this decade?
Yeah, we're not seeing anything that's really directly driven that hard at ESOPs with respect to Secure 2.0, especially for mature ESOPs. We are going to end up seeing, and I think that this is one of the biggest thing we're end up seeing the challenges in Secure 2.0 actually are going to be on the 401k side, pertaining to the modifications to the long-term part-time employees. Realizing that now within 2 years, long-term part-time employees have to be available to make deferrals into their 401k plans. So the reason I mentioned that for ESOPs specifically is we do have some ESOPs that have crowds of individuals who are long-term part-time employees, and that nature of that long-term part-time, they've typically been out of the ESOP, but they may need to be in the 401k. So we're going to have some dichotomies with respect to communications on retirement plans. Well, thanks so much, everybody, for taking the time today. We really appreciate not only your business, but also taking the time to be able to listen and think about your planning as we get into now February 1st. We're already a whole month down for the year.
And we'll be sending out that takeaway checklist, the recording, and possibly the PowerPoint slides too. But please don't hesitate to reach out with any other questions in the meantime. Thanks everyone for attending today's program, and let us know any questions. Thanks everyone.